How do I know what's a good mineralite, a bad mineralite, or a great mineralite? I find in my business so many mineralites, so-called experts, are always talking about why they're experts in mineralites. But if you sat down with them, had a simple discussion about exploration, they couldn't tell you which way a drill bit turns. What they generally do is they say, look, I'm going to mark those mineralites up for a higher price and find me an unsophisticated sucker to sell those mineralites to.
I'm Troy Eckard. I'm the chairman of the board of Eckard Enterprises located in North Texas. We like to drill wells, we like to make money, and we like to educate and attract high-income, high-net-worth investors as we try to show you how you can be successful in the oil and gas industry in America.
I get asked quite often, Troy, you guys are in the mineral rights business. You guys look at and evaluate mineral rights from coast to coast, basin to basin. How do I know what's a good mineral right, a bad mineral right, or a great mineral right? And I can tell you that's really a great question, except it has a lot of variables that we have to consider at all points in time. So let's just be practical. Last time I checked, there was 2.2 billion net acres in the United States. Of that 2.2 billion acres, maybe 300 to 400 million acres are currently involved in the largest oil basins in the country. So when I think about it, we're talking 12.5 to 15% of all the acreage in the entire United States probably has oil and gas of some type of commercial value. That's an ocean, folks. That's 300 to 400 million acres. And if we want to go by 5, 10, 20, 30 acres, well, it's like trying to find a sand granule on Mars. That's exactly going to fit the description you have for that sand granule. We look at it a little bit differently. The way we look at mineral rights is we look at it purely from an economic standpoint. I can buy minerals every day, all day long. Whether or not it's the right mineral right at the right price, that's where 4 decades, 40 years of experience plays a major role. I have to understand what it costs to drill the wells. I have to understand what that oil and gas company is looking for in rate of return and what kind of reserves they're looking to produce to make the decision whether or not they want to spend the capital to drill wells on mineral rights I might own or desire to buy. If I don't really pay attention to the exploration side of buying mineral rights, then I'm just throwing a dart against the board with my eyes closed and I have no idea which wall the board is on. I find in my business so many mineral rights, so-called experts, are always talking about why they're experts in mineral rights. But if you sat down with them, had a simple discussion about exploration, they couldn't tell you which way a drill bit turns. They couldn't tell you why wells are being drilled on certain mineral rights. What they generally do is they say, look, I'm going to find a large area where there's been previous drilling activity. I'm going to find mineral rights that are below market, don't care whether they produce or not. I'm going to mark those mineral rights up for a higher price and find me an unsophisticated sucker to sell those mineral rights to. I'm going to claim I'm in the Marcellus Basin. I'm going to claim that I'm in the Haynesville play. I'm going to claim that I'm in the Anadarko Basin, Oklahoma. And you might be part of a 40 million acre basin, of which only maybe 5 to 10 million acres will be developed economically at today's financial parameters. So yes, you are in the Anadarko Basin, and you'll never see a well drilled in your lifetime because you're not in the core, the heart, or the economically viable part of the basin in today's financial circumstances. So one thing I felt and have felt all along is by being involved in exploration since I started my career in 1985, I always want to know the jockey. I want to know who's drilling the wells that are going to be drilled, potentially on the minerals I'm going to buy, how they drill their wells, why they drill their wells, the economic parameters that allows them to commit the capital to drill wells that will ultimately extract the oil and gas from the mineral rights that I've acquired or I'm considering to buy. If I know the who, I know the why, and I know the economic parameters, it allows me to assess mineral rights not just from a geological standpoint, it allows me to really look at the financial component, which at the end of the day, the financial component is going to drive the activation on the mineral rights that I want to buy. If oil prices are at a certain level, I'm going to get a certain number of wells drilled because the price makes sense and the economics are viable. If commodity prices shift, but technology advances and the technology overcomes maybe a downturn in the commodity prices, I still have a viable mineral acre, but it's for the different reason. It's because I'm saving capital. I know that many of you are not going to really appreciate the great, good, or fair mineral rights, but I can assure you some of the mineral rights you looked at 5, 7, 10 years ago that I looked at 5, 10, 20 years ago, I thought were either minimal value or of no value today are incredibly valuable. What changed? Technology, exploration, development, harvesting, proof of concept. In other words, mineral rights are macro in review, micro in acquisition. I know where the basin is. I know it has 40 million acres. I see the historical drilling. I see the historical results. I look at the different players and operators drilling wells in the basin. I then make assessments based on their drilling pattern, their frequency, their style, their capital explanations, their capital deployment. And I began to say, here's a pattern that's evolving. Maybe I want to buy a little bit of acreage that doesn't even have a well drilled on it at the time I buy it. Because why? My basis might be really low. Maybe it's only 4,000 or 5,000 an acre. I might want to buy a vintage acreage position that says, look, there's one well that was drilled 7 years ago. It proves the oil and gas is in place. It proves it's economically viable. Most likely, they're going to come back and harvest that particular permitted unit, and they're going to drill more wells on the mineral acres underneath that older vintage well. Maybe I pay $5,000 to $8,000 an acre for that right. And then you have the obvious. The obvious is I have a producing well. They permitted 4 more wells. They got 2 drilled uncompleted. And that's kind of like an idiot could find because it's already obvious there's more enhancement, more reserves, more cash flow, more value as a result of the entitlement of that mineral block. But if I want to really be an expert and know the difference between good, great, and just average or poor, it's going to be a total focus on the geology and a total focus on the exploration side of the capital chart. I want to know what drives the drilling, the exploration, and production for any given geological basin. And when I look at that particular very detailed assessment of what drives the drilling, it's going to lead me to what I consider to be the most economically great mineral rights to buy. It's going to show me the good mineral rights to buy based on a fluctuation in either drilling cost or commodity prices. And I'm definitely going to be able to delineate what does not make any economic sense based on the financial conditions that may exist at the time I may want to acquire mineral rights. Look, folks, I get a lot of questions about technology. I get a lot of questions about geology. But let me tell you, oil and gas is not that hard. It starts with economics. The economics drive everything. And what may not be economic today may be an absolute home run in 10 years from now if the economics shift. I just want you to know the good, great, and not so great have a lot to do with the experience, the expertise that somebody has, possesses, and understands how to dissect this particular asset class. Thanks for listening.